The most important day of the year for what I'm told is the most important stock on earth. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Gina Martin-Adams.
We're kicking you off to the closing bell here in the U.S. And let's get a check on the markets with the third day of declines right now with the S&P 500 and what's really going to be the first trifecta of daily losses that we've seen since the first three sessions of the first month of the year. A big drag from big tech, including from cybersecurity stocks. This after a major earnings disappointment over at Palo Alto Networks. Some bright spots out there with a massive rally in natural gas stocks. This after Chesapeake Energy announced plans to lower production following the months-long collapse in heating fuel prices. And you got some strong bids, believe it or not, into utilities like Exelon, as well as discretionary names like Starbucks as well. Across the cross-asset space, you got some modest gains in the dollar, modest losses for crypto, and softness once again in Treasury prices, yields being nudged back up just a little bit closer to those year-to-date highs. Now you put it all together and you have a bit of a reset and a bit of a rethink of market valuations following that 20% rally in the S&P 500 off of those October lows. It was a monster rally that included a 30% gain for Amazon, a 40% gain for Netflix, and a 50% gain for Meta. No wonder some investors are now looking to protect profits with big question marks as to just how much more room this rally could possibly have to run. And that brings us to the headliner of the day. What else? NVIDIA. By virtue of quintupling in price over the past 16 months alone, it has now become the most important stock on this planet Earth. At least that's according to Scott Rubner and the technical trading specialist over at Goldman Sachs. The pre-earnings trading frenzy around NVIDIA, 70 million shares swapping hands yesterday, Tuesday, well above the one-year daily average of 47 million shares. And with less than an hour to go in today's session, it is possible Wednesday's volume could surpass Tuesday's. NVIDIA's options, both calls and puts, we should add, are the second most active in the U.S., at least for a single equity security, second only to Tesla. More than 70,000 call contracts and almost 500,000 puts trading yesterday. Most of that volume today in the $700 strike calls expiring this week. You got open interest on NVIDIA options right now around 3.6 million, with the biggest chunks of that centered around upside calls with mid-March expirations. A bullish and, well, somewhat concentrated positioning that means a big beat or a big miss could have big implications for what at least right now seems to be a very codependent market. Gina?
Thanks, Romaine. Let's kick things off with Julian Emanuel, Chief Equity and Quantitative Strategist over at Evercore ISI. Julian, help us make some sense of this market. You have a background in derivatives, right?
I certainly do.
So you have a lot of knowledge to share with us about what this options market means and what it might mean for the index itself.
So our phrase is we call it the stock that is the market right now. That's
Yeah.
our official phrase. When you think about it, the first thing we want to know is that after 4 o'clock, when that announcement comes out, the option market is pricing a 10% move, either up or down, versus a typical 6.8% move, which is very high anyway. But if you think about it in the context of the last couple of days, to think that you could still move another $70 either way is very, very intense volatility. The other thing that's important to know about the options market is that, and look at the gains. Until the peak a couple of days ago, you were up 45% on this stock year to date. Never mind the quintupling in the last couple of years. 45% year to date. Is that options skew? It's almost always the case that puts are more expensive than upside calls. That has not been the case here for the last week or so.
Really?
That is a bit of maybe potentially, given the last 2 days, irrational exuberance. So we think there's going to be a lot of information in how the stock trades after the announcement.
It sounds dangerous. It sounds more, though, unstable, not just for NVIDIA as a stock, but maybe for the broader market, given the weighting that NVIDIA now has in the S&P. Something like the third or fourth weighting, right?
So, look, the shifting sands of the Magnificent Seven, let alone the S&P 500, have been pretty intense in recent weeks. I think there's an argument to be made that it's no longer the Magnificent Seven. It's now the Magnificent Six. And the largest, the most iconic brand has been going sideways for weeks on end. It's on the balance of maybe getting kicked out of the Mag 6. But we have to remember, that that's what's driven the market in the first place. Outsized earning gains in all of these names, valuation that to a certain extent has leapt ahead of the other 493.
Right.
But because you've had these earnings gains, when you get this kind of concentration, there's always the risk of more volatility.
There is risk, but to play devil's advocate, I mean, this is a company, no matter what we learn tonight, we're going to see big profits, we're going to see big cash flow, and we're probably going to see relatively decent growth on the revenue side. Now, whether that meets the high bar that the market has set, that's a whole nother conversation. But when you take that into context of what the other S&P 500 companies are reporting, at least the ones that aren't part of the Magnificent Seven, there's really nothing, at least on a relative basis, that comes close.
No, absolutely not. And it's all the more different is, look, we've done a lot of comparisons about the price action now versus what we saw in year 2000. And the good news is the valuations in aggregate are nowhere near as high, even though they are expensive, and you don't have signs of an economic downturn like you did in year 2000. And you're also talking about a company that has grown its earnings at a rate unknown to any other company except, you know, the smallest micro cap.
And Gina, I mean, I would love to get Gina's opinion on this too, because Gina, I was trying to go back to try to find a parallel to this, and I went back and when you had these crazy days around Netflix earnings and around Tesla earnings, but those companies weren't even profitable around those times. I mean, Nvidia is a much different story.
Yeah, the only parallel we really have is in the post-pandemic environment, because we've been in such a strange era of concentration risk, and that sort of leads me into my question is for Julian is, are you seeing any signs of budding optimism in the rest of the market? Is this really just a Mag 7 market? Because when we do our work, we do see that breadth of earnings recovery is improving, but albeit very, very modestly. Where would you turn as an investor beyond the Mag 7? Where are you looking for ideas?
So there's a little bit of optimism, as you rightly pointed out, but we're not convinced that it isn't sort of fleeting the way we saw last May and June when we thought breadth was starting to expand and where we thought the earnings season might be better, and that was a bit of a false dawn, as it turned out. Then you had that correction into July and into the October bottom. For us, what we found is sort of the tried and true formula of the sectors that have historically performed well from the Fed's last hike to the first cut. Very defensive mindset, because most of the time the Fed cuts rates because the economy is slowing down. The thought is that may not be the case this time, but communication services, healthcare, consumer staples, and I would say particularly healthcare and consumer staples really left in the dust last year in the sort of fallout around GLP-1. So you get, you know, earnings growth, stability, and a good valuation discount that is now making itself up.
So for the broader market, does that mean we see a little bit more left in this rally, at least this year?
We think it's going to be choppy. We think it's going to be, look, again, when you get to valuations of this level, the 1 year forward average is 0. Now, that doesn't mean you can't go up, because you can get to very overvalued from modestly overvalued. It usually means year 2 and 3 are on the negative side. But to us, put it together, put politics, geopolitics, which have obviously been in the headlines and is going to accelerate, and we think it's going to be sort of a choppy, continuous stock pickers environment.
All right, Julian, always wonderful and always a great take. Julian Emanuel, one of the best in the business, chief equity and quantitative strategist over at Evercore ISI, helping us kick you off to the closing bell here on this Wednesday afternoon. Coming up, more insights on the economy, the markets, and the Fed. Rich Clarida, global economic advisor at PIMCO and former vice chair at the Fed, will be joining us shortly. Plus, our stock of the hour today, we're taking a closer look at Palo Alto Networks, plunging the most ever after cutting its outlook. A lot of discussion right now about cybersecurity and the sector and what it could mean. And a closer look at your 401k and your retirement account. And, well, is it the end of an era? We're going to talk to Allison Schrager, who actually predicts that, well, the 401k, at least as we know it, may be no more. That conversation and so much more coming up here on The Close. This is Bloomberg. We had one of the more consequential Fed meetings at the end of January, and today, the Federal Reserve released minutes from that meeting just about an hour ago, and most officials, they did express concern over moving too quickly to cut interest rates. Markets have already been dialing back bets on the number of rate cuts this year. Michael McKee joining us right now for a closer look at what we learned, our Bloomberg economics correspondent down in Washington, D.C. And Mike, the discussion at this meeting, was there any sort of meaningful discussion about actually cutting rates?
There was not a discussion about cutting rates, except in the sense of warning against it at this point. Now, you have to remember 3 weeks ago, markets were expecting 6 rate cuts this year, and the Fed would start in March. And so a lot of the commentary in these minutes was framed around that argument of whether they would be doing what the market suggests or not. I pulled 2 quotes for you here. One is from the overall outlook that the Fed was embracing. In discussing the policy outlook, participants judged that the policy rate was likely at its peak for this tightening cycle. In other words, nobody as of 3 weeks ago was talking about raising rates. They were still talking about inflation as a danger, thinking the risks were still tilted that way. Most participants noted that the risks of moving too quickly to ease the stance of policy and emphasized the importance of carefully assessing incoming data in judging whether inflation is moving down sustainably to 2%. There were a couple of participants who pointed to downside risks, the idea that perhaps they could hurt the economy by keeping rates too high for too long. But as the quote says, most members suggested, Romaine, that they felt that it was more of a danger of inflation if they started cutting too soon than they would need to raise rates.
Michael, did you get any sort of indication of what aspects of inflation they're watching, what data points they're watching most carefully out of these minutes, or any of your work with the Fed since the last meeting?
No, they really haven't said, in the minutes they haven't said. In some of their commentary since the last meeting, Fed officials have said they're looking at services inflation, they're looking at housing inflation. Everybody thinks that goods inflation is going to keep going down, but the question is, do services keep going down, and how much pressure do service industries need for labor? How much pressure does that put on inflation overall? Those are the things they'll be watching for closely. Unfortunately, we didn't really get a roadmap in the minutes today.
Yeah, we do show a little bit maybe of a roadmap going forward, Michael, at least for the data that we get with that PCE data coming in at the end of next week, and then got to wait a couple more weeks before we get the next big CPI report here. I know we've had this speed bump from the most recent reports that we got last week here, but is there any sense that that overall trend line of disinflation was really disrupted?
No, the general feeling is it was maybe sort of a one-off or a 1 or 2 month off kind of thing. The categories that did not cooperate are not things, well, they're volatile. They're not things that continue in the same direction regularly. So it is probable that we're going to see some sort of change over the next month or two. The big question is with the PCE, how much will it reflect what we saw in the CPI of higher and stronger inflation, and how much of it will continue to be run much lower than the CPI has. There will be a lot of attention paid next Friday.
Absolutely. Michael McKee, and of course, we'll be all over that as usual. A nice breakdown here of some of the data that we've gotten, the Fed minutes that we got today, Gina, and of course, the big inflation prints that we're going to get over the next couple of weeks. That PCE data is going to be interesting because everybody was so focused last week when we got the CPI data and the PPI data and wondering how that's going to feed into PCE.
Yeah, and for stocks, I think there's a lot of mixed emotions with respect to inflation, because generally, as long as those consumer prices are rising faster than producer prices, which has been the sweet spot that we've been in now for about a year, that's a great condition for margin growth. But at the same time, if those consumer prices are rising a little bit too quickly and they prevent the idea of an interest rate ease coming at the Fed, it's not great for valuations. So the equity market, I think, has reflected this conundrum of, well, on the one hand, it's okay. On the other hand, it's not okay. And the result is this really mixed sort of outlook for stocks on top of what is clearly some distress evolving in the tech space and the AI theme. earnings.
Yeah, we're going to have Rich Clarida on a little bit later. It'll be interesting to get his thoughts on that, a focus on the macro as well as a focus on the micro with about 44 minutes into the closing bell. A lot of earnings coming after the bell tonight, including NVIDIA and Rivian and Lucid. Rivian reporting quarterly results, and investors are hoping the EV maker can, well, pump the brakes on burning through cash as EV demand slows. We're going to talk about what to expect out of that report and why the stock is moving in the way it is. That's coming up next on The Close. This is Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Norfolk Southern, an upgrade to overweight over at Barclays. This after activist investment firm Ancora called for a new CEO and a complete overhaul of the railroad company's board. The analyst over at Barclays says new management actually wouldn't be such a bad idea and could improve operations. Those shares getting a modest bid today, up about 1%. Next up, let's take a look at Vizio, a downgrade today to neutral over at JP Morgan. Analyst Corey Carpenter citing the shares trading at a discount compared to Walmart's proposed acquisition price. And here's the thing. He says a better offer would need to come from a company, i.e. not Walmart, that finds strategic value in Vizio's SmartCast operating system if it wants to go toe-to-toe with competitor Roku. Shares of Vizio on the back foot once again, down about 0.6%. And let's take a quick look here at Home Depot, getting a sell equivalent rating over at HSBC. Macro headwinds weighing heavy on the home improvement market, and the analyst saying she doesn't see any near-term catalyst that can boost Home Depot's poor sales momentum. She goes on to say that operating cost inflation is growing faster than sales, putting pressure on margins and overall profitability. Investors knocking the shares down just a little bit here on the day, about 0.2%. And those are some of our top calls. We do want to stay in the sell side space and move on to EVs. We are going to get quarterly results out of Rivian this afternoon. And the big question on everybody's mind, does the unprofitable startup have the numbers to cruise through the EV slowdown? The company has been ramping up production in order to start making profits, but that requires burning through, well, more cash, which is pressuring the stock. Chris Pierce joining us right now for his take. He's a senior analyst over at Needham & Company. He's got a buy rating on the shares. All right, Chris, let's get right to it. There's been so much talk about the broader sort of EV slowdown here. And I'm wondering, A, if that is being overblown a bit, and if so, how, if at all, that's affecting Rivian.
Thanks for having me, first of all. I don't know that it's being overblown when you see EVs from legacy OEMs on dealer lots lasting a lot longer, staying longer on the lots versus ICE vehicles or hybrids. But I don't think that, I think investors are painting with too broad a brush when they look at a company like Rivian versus an EV offering from a legacy OEM is how I would frame it.
Well, so when we talk about the numbers that we're going to get tonight, I mean, obviously everyone really wants to know how many cars they plan to produce this year and how many they plan or they think they are going to actually deliver here. What is the mismatch between those two numbers right now?
I think the most important KPI for the company is vehicle deliveries in 24. And right now, consensus is at about 65,000 for the year. The company will most likely only guide to production at their Illinois facility. And I think, the most important thing is we see a production number that gives investors confidence that the 65,000 vehicle delivery number can be met or exceeded, because then you have higher fixed cost absorption, and that leads to a greater amount of faith in Rivian achieving positive gross margins in 24, which they have guided to, but consensus is well below at this point in time. So I think it's about just the 24 delivery number and increasing investor confidence in the current number or potentially moving higher.
Talk to us a little bit, Chris, about the productivity of this company and just the profitability in general, because I think that one of the complaints on the part of the analyst community is that this is a company that is underperforming its peers in terms of margins. Are there some operating levers that they can be pulling to improve that perception in the marketplace?
So 24 is a big year for margins and operating levers that you speak to. They're going to actually shut down R1 production for a couple weeks in the summer to bring down the line. Then when they bring it back up, they're talking about being able to produce more vehicles, more efficiently with less parts, better component costs, and that gets to steep gross margin ramp in the second half of the year, which gets them to positive gross margins in 24. And I think that if you believe that they can hit somewhere around consensus vehicle deliveries, then belief goes even higher in margin, the margin kind of guidance that's given, and right now consensus is below that. So it really comes down to units driving margin expectations and what we hear tonight.
It does also seem that default risk and sort of just the overall indebtedness of the company is an overwhelming underlying concern on the part of the analyst community. Talk to us about their debt load. How are they going to market? Will they need to go back to market? What are they doing with debt right now?
They've raised $3 billion in the convert market this year. And I think that, most investors, even bullish investors, expect them to raise further capital as they move to the R2 plant in Georgia. I think that's sort of known and in the stock. What I think would, be a positive for the stock is, again, going back to 24 deliveries being in line with consensus, increasing faith in gross margin guidance that they've given, and then all of a sudden the amount of money that needs to be raised moves lower. If gross margin guidance looks like it's not going to be kind of where it was prior, or they have to move lower, that calls into the need for more capital. And then, like you spoke to, these are companies, Rivian and Lucid and their peers, where investors have been putting capital in but not quite seeing the immediate returns. So I think anything that shows that capital discipline and capital that they've taken in can go further will be a net positive.
So are we looking at a situation, though, Chris, where we might be talking about a capital raise at some point this year?
I think even bullish investors expect Rivian to raise capital this year.
Yeah. Okay. And how do you think that's going to come to fruition? Are we going to see that through stock? Or are we going to see that through debt, or something in between?
They tapped the convert market twice last year. I think this year might be more on the equity side of the world, but I think it's still, dilution is dilution. We'll sort of see how it plays out.
Yeah.
But again, I would stress that I have a $2 billion raise in my model for this year, and I think that most even bullish investors expect the company to raise capital this year.
All right, good stuff, Chris. Chris Pierce over at Needham. A closer look at Rivian. That company expected to report earnings after the bell tonight. And Gina, the big take on the Bloomberg terminal today is really all about the fever dream, at least here in the U.S., to basically have half the cars on the road be electric, or at least non-gas guzzling cars by 2035. A pretty ambitious target by the Biden administration that kind of looks like it's in jeopardy right now for a wide variety of reasons.
Yeah, it doesn't seem like the U.S. consumer is quite willing to fulfill that dream.
Yeah.
They're not going out to the market. And maybe a lot of it is about pricing, and some operational efficiency can help with pricing ultimately.
Yeah.
If we can get some efficiency improvements in general conditions of operating and productivity in that landscape, then maybe those companies can pass on that price improvement to the consumer. But right now, it just does seem to be about price.
And it was so interesting to hear Chris talk so much about the cost issue, which is not just a Rivian issue, but for all these companies. And then you read the story, the big take, and it really talks about how some of the policies that the Biden administration is pursuing, at least in the short term, are going to make things probably a little bit more costly, because you're restricting the ability to get cheaper goods from China that would go into these vehicles. So maybe in the long term that pays off, but in the short term that probably means higher costs for the automakers.
Yeah, which again, it feeds right back into will the consumer actually go out and get these cars if the automakers have to charge more for them? That's a really difficult proposition of value.
All right. Well, speaking of the Biden administration, Gina, we actually learned that they are going to forgive about $1.2 billion of student debt loans. Now, this covers about 150,000 people, part of a big initiative by the Biden administration. We're going to get you some more details on that and, well, what the economic impact might be. This is The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Gina Martin Adams.
Another down day for the markets, Gina. Third straight day of losses. And a lot can change over the next couple of hours. We're going to get NVIDIA after the market closes. And we know it's just the outsized effects that could have on this market is tremendous.
Yeah, and I think when we got the news from Palo Alto, that sort of set a stage and set a tone that the market is not too excited about what it's going to see out of NVIDIA as well. I mean, frankly, when you're talking about stocks that are up 30, 40, 50% year to date, you're looking at stocks that were vulnerable to some weakness to start with. But I think that there are a few longer term questions that are starting to get asked by the investor base, which may have gotten a little irrationally exuberant here in the last few weeks.
Those earnings expected after the bell tonight. We're going to spend most of that 4 o'clock hour really focusing in hard on NVIDIA and the tech sector and AI. But let's cleanse the palate just a little bit and talk a little bit about what's been going on in Washington. The Biden administration has announced that more than 150,000 people will get $1.2 billion in student loan forgiveness. The move affects borrowers who have been making payments for at least a decade and who took out $12,000 or less in student loans. Jordan Fabian, who covers the White House for us at Bloomberg, joining us right now for a little bit more on this. And Jordan, maybe you can kind of just help me remember, because I thought this was kind of a dead deal given the Supreme Court ruling. What is different about this loan forgiveness program versus the one that ended up at the Supreme Court?
So President Biden tried to enact broad-based student debt relief that would wipe out probably $400 billion in student debt. That was struck down by the court last year. And so in the meantime, he's been able to take some targeted actions related to different federal student loan programs. So he did that today, the SAVE program, the federal SAVE program. So borrowers who have been paying back their loans for more than a decade qualify, and borrow less than $12,000 qualify for this round. So he's able to do these smaller moves, but as far as the broad-based relief that he was aiming for, that's still on hold.
So this is a pretty small percentage of the overall student debt, but you talked about him sort of picking away at these programs. Are there other things in the pipeline that we can look forward to with respect to student loan debt forgiveness programs that he's thinking about?
The administration hasn't telegraphed their next moves, but you can bet as the election gets closer that the administration is going to be looking for more of these opportunities to target and wipe out more student debt. This is a key issue for young voters and voters of color. These are people that President Biden needs to show up at the polls for him in November. And so he's trying to do as much as he can while his hands are tied by the courts on the more sweeping debt relief that he wanted.
You think this is going to get him some currency, I guess, with some of those folks out there, folks who kind of felt that this should have been done before and it should have been done at a much larger scale?
That's what he's hoping for, but it's going to be difficult for him. Bloomberg News has a poll that shows 43% of young voters in swing states are dissatisfied with the president's moves on student debt. As we talked about, that big move was blocked. That's what he promised on the campaign trail in 2020. That's what those young people, student borrowers, were looking for. That hasn't happened yet. So absent that big move getting freed up, and the administration is trying to do that through another legal avenue, a lot of those voters might still remain dissatisfied despite the administration's best efforts to target smaller groups.
Jordan Fabian down in Washington, a closer look at the Biden administration's latest effort to relieve some folks of their student loan payments. We want to go, I guess, to the other end of the lifetime spectrum, if you will, and talk about retirement, and specifically 401k retirement plans, a fixture here for many American workers, and those assets held in those plans have been growing rapidly. But some economists say that the 401k will vanish within a decade. In fact, the most read story, one of the most read stories this week on the Bloomberg terminal, has a very salacious headline called 401k plans will be gone within a decade. And the woman who wrote that joins us right now, Allison Schrager, Bloomberg opinion columnist. Allison, always great to have you. You are nothing if not provocative at times. And this headline caught a lot of folks' attention. Let's go beneath the headline and the sensationalism and make the case as to why we're even talking about the potential of 401ks going away.
Well, the government needs revenue. They need tax revenue. And what's striking, what inspired this story was that I'm seeing both left and right-wing economists argue that this the tax advantage status of the 401k does not get people to save more. It doesn't even really increase participation, and it disproportionately impacts the wealthy. So if we're going to look for revenue somewhere, this is sort of a least painful way to go.
Wouldn't the government lean on other bigger levers of tax revenue drivers before they would lean on 401k? I would just think this would be so politically unpopular to increase taxes in this way. And there are other things that they can do that probably would bring through more revenue if it really is a tax case.
Well, it's not a trivial amount of revenue. It is 1% of GDP. And I think the argument is this is relatively less impactful than other things. While, people do like their 401k, they like having a lower marginal tax rate better. So, or, they like their SALT deduction better. So that relative to all the other levers, if people are so indifferent to the tax deduction, it's not even getting them to save more, then this might be an easier thing to get rid of than just, say, increasing taxes across the board or increasing instituting consumption tax or something like that.
I mean, when we talk about, though, getting rid of it, I mean, this is probably a dumb question, but is Washington going to come up with something feasible to replace it or something that would be comparable or even better from a savings perspective?
Well, I think they'll keep retirement accounts. They just won't get a tax advantage. But if you have to deal with a penalty of early withdrawal, why would you bother? And what we're seeing, certainly with Secure Act 2.0, is a push towards having more Roth-style accounts, which people do like better. And in Canada, they have access to Roth-style accounts, and people are choosing those over the tax-deferred accounts just because they like the liquidity.
You mentioned that several economists are talking about this. Has this translated into actual legislators talking about sort of getting rid of the 401k?
No, but this is where it starts. I think what's striking about it is having both left and right-wing economists be like, this is not useful. I mean, granted, there are other things economists say that too, like step up in basis. But, you know, you wonder if there's the same contingency to sort of keep the 401k when even, you know, there's a community of retirement economists. There's maybe 12 of us. And one on the left and one on the right wrote a paper together, so it was notable for our community. But we are influential, or not me, but the others. And I feel like this is where it starts.
You're somewhat influential, Allison. Give yourself some credit here. Allison Schrager, retirement economist. Dozens of you, I'm told.
There are. We're passionate.
Are very passionate, and a great columnist for us here at Bloomberg Opinion, and a great column on the Bloomberg terminal just yesterday here about some of the reconsiderations of the 401k plans. And from a government perspective, Gina, I guess whether it's even a good deal, not just for the folks who are saving or maybe not saving, as Allison pointed out, but also for the government itself.
Yeah, I think it's a really good point. There's a lot of tax considerations with respect to 401k to think about, though. The IRA being an alternative option, but also, you know, how protective is the 401k of the mutual fund industry, which is charging much bigger fees when we could be going into ETFs. There's a lot of things to really discuss and when you narrow this down into how to effectively save and incentivize savings. Yeah,
it'll be interesting. I mean, I started my career right when everyone was transitioning away from, you know, defined benefit pensions into defined contributions and 401ks, and look at us now. All right, coming up here, we're going to take a closer look here at one of the biggest moving stocks out there. It's not NVIDIA, it is Palo Alto Networks, a record loss here on the day after the cybersecurity firm reported earnings, and those earnings disappointed. That's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, with about 19 minutes into the closing bells, it's time now for our stock of the hour, a closer look at Palo Alto Networks, biggest decliner in the S&P 500, a 28% drop in the shares, the most on record. This after the company cut its forecast for both revenue and billings. Palo Alto says it's simply a change in its go-to market strategy, but investors aren't necessarily convinced. Abigail Doolittle joining us right now to talk a little bit more about this. And Abigail, this is a huge market reaction here. I mean, is it justified?
It's really incredible. And it's a case of too far, too fast, price to perfection. But the interesting thing is this stock is still priced to perfection because into today through last year, it had been up 120%. Right now, over the last year, it's still up 57%, 44 times a forward PE versus the group at closer to 28 times. So again, it's still a little bit above the group. Now, relative to what went wrong, it was that guide that you were talking about below consensus. That's part of the color that you were talking about, the go-to market strategy, and we can talk about that in a moment. But they also mentioned a fatigued consumer. Investors just don't want to hear about that because it's all about the IT spend. This space has been under a little bit of pressure over the last 2 years, a little bit of choppiness as investors wonder whether or not there's macro uncertainty. And from that standpoint, you know, these comments about the IT spend, that I think is really the big concern that's weighing on this stock.
I would agree this fatigued consumer idea is a bit terrifying for a lot of reasons, but first and foremost because this has been a really big theme in the market, not just Palo Alto, but cybersecurity as a whole. We monitor in our BI strategy team, we monitor 30 different theme universes. Cybersecurity as a whole is the third best performing theme in the market so far this year. Second best flows among all themes in the market. So I'm curious, when you parse through this report, you look at all the commentary, how much of that translates into the theme at large versus Palo Alto specifically?
I think it's hard to know. And relative to investors, what makes it so interesting is they're either really right or maybe not so right. Maybe they're too far over their skis. Maybe they got this story just a little bit wrong. Now, relative to the macro, if it is a fatigued consumer, it's going to be the whole space. That's going to be an IT spending slowdown that would translate into some sort of a not soft landing and not no landing, but some kind of a rougher landing, I would say. But relative to the go-to-market strategy, the changes, they basically are now offering a bigger suite of products for a discount, but they bill them over a longer period of time. And so the billings are coming in slower. So if other companies are not doing that, they might not see that kind of lumpiness. But the funny thing is, Palo Alto Networks is still the leader in this space. So they've had a really rough time. It's hard to know right now whether or not it's if it's going to bleed into the sector, if the sector is going to start to come under pressure. But there's clearly something specific to the company. I think some more time is to tell. And those investors who are so far out in terms of those flows and returns, maybe they're starting to reposition a little.
Yeah, and we're seeing some of the other peers move lower. Zscaler down more than 10% here on the day. I think CrowdStrike, a similar move as well. Abigail, do a little closer look at Palo Alto Networks, a 28% drop in those shares, a record drop for those shares. Biggest decliner in the S&P 500. Of course, not a big point drag on the S&P 500. The biggest point drag, believe it or not, is NVIDIA. Those shares actually kind of dragging things down, as I think a lot of people maybe trying to be a little defensive after all the bullishness that fed into that stock.
Yeah, and for the last several days, really, been defensive. So even in advance of the Palo Alto news, people sort of shying away from NVIDIA and this general AI themes as maybe we've gone a little too far too fast, and we need to take a little bit of a break, put the brakes on here. All
right, we're going to have full coverage of those NVIDIA earnings and everything AI when those crosses the wire after the bell. But as we count you down to those closing bells, 15 minutes away, we're going to be joined by Rich Clarida. He's the global economic advisor over at PIMCO and former vice chair over at the Fed. We're going to get his thoughts on the latest Fed minutes, his latest thoughts on economic conditions, and his latest thoughts on whether the market has it right. That's coming up next, right here on The Close on Bloomberg. This is the countdown to the close. Romaine Bostick alongside Gina Martin-Adams. She leads our coverage over at Bloomberg Intelligence, the chief market strategist there. We got about 10 minutes until we get to these bells, Gina. And we talk about a market that's been on the back foot. Not a huge sell-off here, but certainly a little bit of a rethink, I think, of that big rally. And I think a lot of people are really waiting to see that next big earnings report and whether that's going to justify just how far this market has run.
Yeah, and it does appear that, there were some really strong fundamental reasons why investors were getting a little bit more optimistic. We had a great earnings season. For all intents and purposes, it was a fantastic earnings season. But at the same time, is there really justification for driving some of these AI-themed stocks up 40, 50% in the course of just a few short months? That's where I think we're starting to really question things, and investors are rationalizing their exposures there. Yeah, well, we might get some answers to that. NVIDIA set to report after the bell. Quite a few other companies as well, including Lucid, Marathon, Five9, as well as Etsy. And then, of course, there's still a focus on the macro, even though the micro dominates right now. We did get Fed minutes just a little while ago, and the markets are taking their time to digest exactly what we learned about what the Fed discussed at its last meeting. The big concern there was, well, are they going to cut rates too quickly? At least that's what the markets wants to see, not necessarily what the Fed wants for itself. Former Fed vice chair and now PIMCO's global economic advisor, Rich Clarida, joining us right now to give us his thoughts on, I don't know if it's a conundrum, Rich. Maybe that's not the best way to put it, but this is a Fed that has made clear that last mile down to 2% to a 2% inflation target was going to be a little bit bumpy, and I think we saw that certainly in the inflation reports last week, and we certainly saw that to a certain extent in the minutes and the discussions that were had behind closed doors at the end of January.
I think that's right. I think in particular the phrase that jumped out at me, Romaine, was they said most of the members noted the risk of moving too quickly to cut rates. There was also a reference to some of the progress on disinflation may have been due to idiosyncratic factors. So that skewed a little bit in a bit of a hawkish direction. Of course, since that meeting, we in the Fed have gotten the CPI inflation data, which came in very hot, and a gangbusters employment report. So as is often is the case, these are a little bit stale. But my bottom line is maybe a touch more hawkish than perhaps we got out of the chair's press conference in January.
Are you convinced that where rates are right now, meaning the Fed funds rate, that is indeed the peak?
Well, you start with what they think, and they think it's the peak, and the minutes confirmed that, and Chair Powell more or less said that at his press conference. So I think that has to be the baseline. In life and in Fed policy, there are risks on both sides, and so you wouldn't want to attach a zero probability to the fact that they may need to hike if inflation moves up. which they don't expect, and we don't expect. But yeah, they think they're done, and they probably are done.
Rich, talk to us a little bit about the role that the jobs market is playing in the Fed's decision process. So when they're thinking about growth and they're thinking about jobs and the sort of stickiness of the jobs market, is that the key factor here? While we're all focused on the inflation numbers and getting back to 2%, isn't it really about, are we seeing enough jobs weakness to really justify a cut?
You know, I think the Fed's thinking has evolved. The traditional macro model would say if you want to slow inflation, you got to see at least some rise in the unemployment rate. We have had a slowdown in wage inflation. Indeed, the employment cost index, which I think is the one they follow the most closely, has shifted down into the high threes. And so I think this is a Fed in particular. A lot of new folks around the table relative to when I was on the committee. This is a Fed that is perfectly happy to have the labor market adjust through wages and vacancies so long as it doesn't necessarily require a rise in unemployment. So I think so far that view has been borne out.
And then how do you think they incorporate the signals from the market itself? Obviously, the bond market has been pretty frenetic around the last couple of months, pricing in for several cuts and now really contemplating maybe a hike. Do they care what the bond market is doing around these times? Are they a little bit concerned about the degree of volatility that has emerged in the bond market?
You know, I think and I've pointed out to this before, you know, there was a disconnect that opened up after the December meeting. At the December meeting, they indicated that most participants thought that 3 cuts this year would make sense. And the market at one point was pricing in 6. Yeah. So since we got that hotter CPI and employment data, there's now a pretty good alignment between at least where the Fed was until recently and where market is pricing. So, you know, I think that's going to be part of this cycle. It's been part of other cycles. If you look at the record, you know, when the Fed says they think they're done, the markets will be off to the races to price in those cuts. So I think more or less this is part of what they're expecting. But I think there's a better alignment now than there was after the December meeting.
Is the labor market right now, Rich, the job market, is that also aligned with that same narrative?
It's moving in that direction, Romaine. I think they have pointed out, if not in the minutes, then certainly other times, that, you know, wage inflation, you know, compensation is about 2/3 of cost for many companies, is still, you know, a little bit hot relative to the number that would be consistent with price stability. On the other hand, we have been getting some good news on productivity. Productivity now, even if you average through the pandemic gyrations, which were substantial, productivity growth is probably at the high end of where it was before the pandemic. And that's quite important. Unfortunately, productivity is hard to forecast, but strong productivity numbers definitely move in the direction they want.
Well, I'm glad you went there because there's been a lot of concerns as to why we haven't seen a more meaningful shift in productivity, higher productivity, at least in past economic cycles. We're getting some of that now. But as you know, Rich, there's a lot of talk about artificial intelligence and all the companies involved in that, and what it could potentially mean for labor productivity and just the overall efficiency of this economy. I know it's kind of early, but do you see a promise that AI and some of the technologies associated with it could lead to greater productivity?
Sure, there's that promise. You know, technologists think that it potentially is at least as big a deal as, you know, internet connectivity and personal computing was. And of course, that led for at least a decade or so to about a percentage point increase in productivity. I think it's too soon to tell, but obviously, you know, that's a real possibility. And part of what stock markets do is try to value, you know, that possibility. I think right now the Powell Fed is really focused more on the here and now. They've also benefited, the economy's benefited from an increase in labor force supply as well. So I think that's their focus.
All right, Rich, got to leave it there. Great to talk to you. Richard Clarida, former Fed Vice Chair, now PIMCO's Global Economic Advisor, helping us count down to the closing bells here on this Wednesday afternoon. We should point out the S&P, which opened lower, spent most of the session in the red, now flipping into the green. The NASDAQ still in the red, but touching session highs as we await results out of NVIDIA. Stick with us. We're going to have a full breakdown of those results as we take you to the bell and beyond.
Beyond Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Gina Martin-Adams. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar, Jennifer Ryan in today for Tim Stenovic. Welcome to our audiences across our Bloomberg Television, radio, and originals platforms, as well as our partnership with YouTube. A consequential day potentially here, Carol Massar, a market that has rallied hard to start the year, and a lot of that was on the back of NVIDIA.
Yeah, absolutely. Any kind of surprise to the upside or downside could really and is likely to impact market sentiment. Having said that, I heard you a little bit kind of getting into the setup here. It's been interesting to watch in the last half an hour the buying coming into this market.
Not only the buying, but also the big just shift in sentiment, because I mean it's just been down so heavily all day that it's interesting to see anyone having a positive change at all. So I'm very interested to see what the views are there.
Well, and let's just think about things beyond tech, right? I think that when we get so captivated on what's gone on with NVIDIA, what's gone on with Palo Alto, it's been all AI. But frankly, when you look beyond what's going on in tech, there's generally some pretty positive news coming out of companies. And I think that that might allow for some stability to emerge overall in the equity market.
Yeah, and we should point out, despite the fact that it's a down day, the majority of the S&P sectors have been in the green for a good portion of the day, but it's just not, of course, the type of stocks that most people turn to. It's energies, utilities, real estate. Meanwhile, tech remains the laggard here, but of course that could change in a pretty dramatic way in the next few minutes. We are expecting to get results out of NVIDIA, as well as quite a few other companies outside of the tech space. That includes names like Etsy, names like Five9, as well as two big EV players, Lucid and Rivian. We walk through the numbers with green on the screen for two of the indices. The Dow average up about 0.1% here on the day, up about 40 points as we wait for these numbers to settle. The S&P 500 looks like it's going to close higher by about 6 points, or about 0.1%. The Nasdaq Composite, though, has been in the red all day, and that's where it's going to finish, down 0.3% here on the day. And let's check in on the Russell 2000. That is your relative laggard on the day, down about 9 points, or about 0.5%.
All right, back to the big caps I go here in the S&P 500 specifically. As you said, Romaine, a lot of the industry groups in the S&P 500 were in the green for most of the day. If I look at the mix here, 327 names in the S&P 500 gaining ground today, 174 losing ground, to Gina, unchanged.
Yeah, and I think the sector performance is really interesting today as well. We got actually 65% of stocks closing higher on the day. This is not a horrible day in the equity market by any stretch of the imagination. Most sectors higher, tech, of course, the only laggard. Energy, 100% of energy stocks up on the day. So clearly something going on in the commodity space. Utilities and real estate up as well, which would suggest maybe the read-through from the market here is that those interest rate sensitive sectors are about to get a little bit of a benefit with a Fed ease coming sometime in the next 6 months. So maybe there was enough in those minutes, or there's enough in the news coming out of tech to suggest that the pressure on inflation may not be as horrible as we were thinking over the course of the last week.
And I don't think there was anything in the Fed minutes, right, about an increase, right? So that maybe was some sigh of relief here. Hey, let's get to some, as we wait for earnings, some of the individual gainers, if I may. Toll Brothers on that list, finishing with about a 4% gain off its highs, at its highs up almost 8%, but it did rally to a record. The luxury home builder lifted its outlook for home deliveries in its fiscal year, also said it's optimistic about its prospects for a key selling season. Exelon, another earnings season, the electricity utility among the top gainers in both the S&P 500 and NASDAQ 100. Fourth quarter adjusted operating EPS, operating income all beats. Company raised its 2024 adjusted operating EPS, also raised its quarterly dividend. So some big moves in that name as well. Exelon, just bringing it up here, it was up about 4.25%. And then Garmin, another outperformer, a gain of nearly 9% just off its highs. Another top gainer in the S&P 500. We got earnings this morning. Fourth quarter revenue and pro forma EPS were beats. 2024 gross margin in line with street estimates. It authorized a $300 million buyback, and the stock, I believe, at its highest, it's about December of 2021.
And can I just add, too, I mean, just to Gina's point, too, about energy stocks. I mean, when you saw EQT, Range Resources, Chesapeake, those really led the charge when you go across the tape, and that seemed to be on the back of those comments, Carol and Jen, about Chesapeake actually curtailing production this year, which could potentially, I guess, benefit them on profitability.
Right, benefit some of the other ones, right? Yeah.
Okay, so now here I am with the decliners for today. I'm going to start off with Manchester United. Their shares dropped, they were down, let's see, let me just get myself to the right screen here. Their shares were down about 8% by the end of the day today. And that's as traders who had bet on Jim Ratcliffe's $1.3 billion purchase of a stake in the football club started to unwind their positions. Next up, I'm going to look at Palo Alto. That was a pretty big decliner today, falling the most on record, down a little bit more than 28%. And what happened was the company had cut its annual revenue forecast, and that stoked concerns that customers were reining in spending despite an uptick in cyber attacks. And lastly here, Walgreens Boots Alliance, which has already been mentioned today, down 2.5%. That was after the e-commerce giant is going to get replaced. Sorry, I'm getting it all backwards today. Yeah. Walgreens Boots Alliance is getting replaced by Amazon.com in the Dow Jones Industrial Average, and that change is going to go into effect on the open of trading on Monday, February 26th.
Yeah, a big move there. Remember, there was so much talk about why Amazon wasn't in the Dow. Of course, they did the stock split, and now they get the reward here. Let's take a quick look at what's going on in the yield space, where yields continue to do what yields have done, which is oscillate back and forth. One day they're up, the next day they're down. Today, pretty much up across the board here. About 4 basis points on the 2-year yield, and similar moves on the other parts of the yield curve. So almost not quite a full parallel shift, but similar parallel shift, and it kind of continues the trend I think we've seen, guys, over the last couple of weeks, where people are really starting to buy into what the Fed has really been trying to tell them now for months, which is that we're not going to cut rates anytime soon. We might be at peak rates, but don't just start getting ahead of yourselves with 5, 6, 7 rate cuts.
Yeah,
priced into this market.
Right. That's the big takeaway from the minutes today, right? That, you know, the concern about maybe doing any kind of cut sooner rather than later, doing it too quickly. That was the concern. We were looking for any kind of clues about when they might cut rates. We really didn't get it. Not much different from what we got after that end of January Fed meeting, Gina. But they are still concerned about inflation kind of rearing its ugly head, and they want to make sure that they've got it squashed, if you will, and to make sure that they are on the right trajectory.
Well, and I think it's a great point that, look, this has really been about the markets getting ahead of themselves, the markets getting overconfident in one direction or another. We had Rich Clarida on earlier, and he mentioned that this is not abnormal. At this stage in the cycle, when the Fed says they're about done, the market usually gets far ahead of itself and says, okay, when are the cuts coming? Yeah. So this is just the stage that we're in. We're going to have to deal with a lot of market volatility and anxiety, even if the Fed remains pretty much steady as she goes. All right, we are getting some earnings crossing the wire right now. Etsy shares now down about 6% here. The company basically said that in the fourth quarter, its EPS came in at about 62 cents a share. The Street was looking for 78 cents a share. So a miss on the bottom line. The top line was a beat, $842 million in revenue in the most recent quarter. The Street was looking for 827. So a beat on the top line, a miss on the bottom line, and gross merchandise sales, which is a number that a lot of people pay attention to, that was down on a year-over-year basis, down about 1%, though it did come in just a smidge above Street estimates at about $4.01 billion. The Street, guys, was looking for 3.97.
All right, guys, let's move on to Lucid. Lucid Group coming out with its earnings as well. Fourth quarter loss of 29 cents a share. That was widely what the Street was expecting. Fourth quarter adjusted EBITDA loss of $604.6 million. That is better than what the Street was expecting. They were looking for a larger loss of $667.1 million. Fourth quarter revenue, $157.2 million. That compares with an estimate of $178.4 million, so a little light there. Also coming out with 2024 production of about 9,000 vehicles. So I'm looking for kind of a year-over-year comparison. I don't see it, but Lucid right now up about 1%. This stock has been taking a beating here in 2024, down about 34%. And they've got some news about some new vehicles expected to come out in March, but nonetheless, we'll look for some more color in terms of what's coming. Right now, Lucid, though, guys, little change, just up about 0.25%.
And we're expected to get Rivian results a little bit later, too.
Yeah,
correct.
At least nice to see some stable performance in such a volatile market where we're expecting really, really big moves. Yeah. To have a slight beat to low expectations seems great, and you're seeing that reflected in the stock price right now. Obviously, this has been a tough market for the EV companies.
Yeah, absolutely. And we were talking, Gina and I were talking on Bloomberg Television a little while ago with a guest just kind of about the EV environment. And, he seemed to have a more positive outlook on it. But it just seems that all the stories we've gotten, guys, over the last few weeks and months is just that people just aren't buying them at the same clip.
What does our Keith Naughton say, right? It's not that they're going away. There's still, demand out there. It's just a bit of a reset in terms of how strong that demand is. We're still seeing growth, but it's just not as strong as everybody, Jennifer, thought it was going to be initially.
Yeah, indeed. And it's a question as well is whether or not the commuter is really going to hold up, because we've seen that very strong spending. But if we're going to have the Fed continuing not to cut, there could be some real weakness there.
All right, guys, continuing to wait for NVIDIA. Should be out in maybe about 10 minutes. That stock's up about 0.7% in the aftermarket. But again, waiting for those results. That's a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We and the team, the whole team, we'll see you again, same time, same place tomorrow.
And stick with us here on Bloomberg Television. All eyes right now on NVIDIA. Expected to get those results any minute now. We will have full and instant analysis as soon as it crosses. Stick with us. This is Bloomberg. Rivian earnings are out. The electric car maker providing guidance well below what the street was looking for. The company says that full year production here this year, 57,000 vehicles. The street was looking for 80,000. The company also says that it plans to cut about 10% of its salary jobs. The company also did say that in the most recent quarter, it did report revenue of about $1.32 billion. That was above what the street was looking for. And it reported a loss per share of about $1.36. That was slightly worse than what the street was looking for. But once again, the big number here is the forward guidance. 2024 production coming in well below estimates, 57,000 vehicles. The street looking for 80,000. Those shares down 13% here in after hours trading. We do want to turn to, well, another earnings report. And this is actually for a private company, but a private company that we all know and love, New Balance. The company saying that 2023 was a milestone year. The company, known for sneakers and athletic apparel, reporting double-digit record growth in every global market, reaching $6.5 billion in annual sales. That's a 23% increase year over year from 2022. Joining us now for an exclusive conversation, Joe Preston. He's the president and CEO of New Balance Athletic. $6.5 billion and that percent growth. Astonishing, Joe. What got you there?
Well, thanks. Hi, Romaine. Hi, Gina Martin. Pleasure to be here. Yeah, it's our third consecutive year of double-digit growth all around the globe. Every region has posted those results, and we're seeing them across categories, footwear and apparel. We surpassed $1 billion in apparel last year for the first time. It's across men's, women's, and kids. And there's really three reasons for it. It's innovation, it's brand activation, and it's operational excellence.
Talk a little bit about the brand activation and, more importantly, brand visibility. I think for a certain cohort of people, New Balance has always had a presence in their closets, in their lives. But the partnerships that you and the rest of your team have gone out to get with people like Kawhi Leonard in basketball, Coco Gauff in tennis, and I know I'm forgetting quite a few others here. How much of an impact have those partnerships had?
I think they've had a tremendous impact. You know, we also have Sydney McLaughlin. We also have Tyrese Maxey. We have over 350 athletes and entertainment ambassadors. And our brand teams have done just a great job of connecting sport and culture. And that's bringing energy to the brand. It's bringing new consumers to the brand. In fact, 63% of our NewBalance.com customers last year were new customers. And we know they're younger just from all the data that we're collecting.
You mentioned innovation as one of those keys to your success. Talk to us about that innovation. What are your new innovations? What are you doing to really attract that customer?
Well, first of all, there's performance innovations that we're bringing into our performance running line, as well as into our cleated product that's worn across a number of sports. And it's also coming from our lifestyle business, where our product teams are reimagining some of our heritage styles. And that intersection of taking our heritage authentic product and reimagining it along with our brand activations is what's bringing us energy.
And where are you seeing the greatest growth globally? As a large global company, are you seeing more emerging market interest, developed market interest, U.S., non-U.S.?
You know, quite frankly, it has been so consistent from every single region. But this past year in 2023, Europe grew over 35%. So they led the way this year. But the U.S. has been up over 20% for 3 consecutive years. Mm-hmm. You know, since the dark days of 2020, we've almost doubled our business and every region's contributing.
I'm curious about the competition out there, particularly when it comes to footwear itself. It seemed for a lot of years there was kind of really only 3 or 4 major players in here. Obviously, Nike and Adidas, the biggest. But now you've got upstarts like Hoka, you've got On Cloud, and a few other companies that have seemed to just kind of come up out of nowhere and capture the imagination of a lot of folks. How do you stack up in terms of keeping yourself not just visible, but more importantly, convincing people for whatever reason that a New Balance might be better than, say, an On Cloud or whatever?
Well, New Balance is unique. New Balance has authenticity. We were the first ones to introduce a $100 running shoe. And then we also, that heritage is allowing us to introduce some of our older styles, our iconic styles, as I was mentioning, reimagining them to a new set of consumers. So we are considered new to a younger generation. And then when they get in and they try to unpack as to who we are, they can go back to our history. And that authenticity is very powerful.
What about, how are you doing right now in terms of your own costs when it comes to making these shoes and getting them out there to the retail set?
Well, I mean, obviously during COVID, costs were significantly rising, particularly on the distribution front. We also make shoes in the U.S., and that cost is higher than our competitors, but we're committed to it. We've been here for more than 40 years in the communities that we serve. We've just opened up a new factory, we just broke ground on a new factory in Londonderry, New Hampshire, and we're very excited about continuing to build our capabilities and producing footwear here in the U.S.
Speaking of your employees in the U.S., how are you finding labor supply right now? We hear, lots of different stories depending upon the industry about scarce supply of labor. Are you experiencing the same? What are the labor dynamics in the footwear business?
Well, I think every company has been challenged over the past few years. I don't think it's as difficult as it was a couple of years ago, but also as the brand is growing, more and more people are seeking us out as a place of employment. So, we've also got a very loyal and stable employment base. Our associates come here and they stay here. So I wouldn't say it's a big problem for us right now.
And how are you seeing the global trade market right now? There's obviously, we're certainly in better condition than we were with the supply constraints of the COVID experience, but there still does appear to be some general friction in supply chains. What are you seeing on the supply chains and global trade?
I think from a production standpoint, there's no issue. The issue is ships that are coming out, going through the canal, and that's causing delays coming into Europe, some delays coming into the U.S. But from a production standpoint, there's no major issues in the industry.
Great.
All right, Joe, great to catch up with you here. An impressive year for New Balance in 2023. Joe Preston, President and CEO of New Balance Athletics there. A nice conversation here about what's been going on in the apparel space. A nice warm-up, if you will, Gina Martin Adams, to some more earnings that we're expected to get. Still awaiting those results out of NVIDIA. They are due at any moment. Let's get you a preview here of what to expect. Kujan Subani, Bloomberg Intelligence's senior semiconductor analyst, joining us right now. And Kujan, we haven't gotten those numbers yet, but expectations are high. What exactly do you think they can say or they can print in that report that's going to justify that big run-up that we had in the stock prior to the last couple of days?
Well, I think including us and definitely most investors, everyone expects a beat and a raise. However, the magnitude of those would be moderated versus what we have seen in 2023. I think something that can really validate would be that the demand signals continue to be strong, especially if they give any commentary around enterprise spending momentum in AI. We all know that the largest cloud customers are spending significant amount in AI CapEx, which is really driving most of this growth. But it would be great to see enterprise and growth outside of these cloud customers.
I am curious, Kujan, there was a lot of discussion today about the downdraft that we saw in Palo Alto Networks and some of the cybersecurity stocks. And I know we're talking about completely different businesses here, but the concern was that there was a slowdown or maybe just a bit of a rethink in corporate IT spending, that maybe their costs had gotten a little bit too inefficient and they need to start looking at things. Is that at all going to be an issue that NVIDIA will have to confront?
Not specific to NVIDIA. I mean, we have not seen any signs of demand slowing for NVIDIA specific products. You got to remember, it is still supply constrained. So everyone is still trying to get their hands on as many NVIDIA GPUs they can. And so you could see sort of a over buildup of inventory through that. But right now, people are just glad to get as many GPUs they can from NVIDIA.
I'm curious, Kunjan, if you could talk a little bit about the long-term aspects of this AI sort of boom and what is maybe priced into the space with respect to expectations. So clearly, expectations are very, very robust in the short term. But if you're looking out 3 to 5 years, do you see those expectations generally as achievable? Or are we getting to the point where even our long-term expectations are just too high here?
I mean, when you look at the overall sort of AI spending rally, things definitely look elevated. I think at some point in the future, the growth rate is likely to normalize. But having said that, it's difficult to really say if this rally has legs to go on for 5 to 10 years. But for NVIDIA specific, we don't see any significant risk for at least until 2025. I think some of the risks regarding China and regarding its largest customers designing their own chips, and if that can slow down its growth trajectory, if they do come to fruition, it would be more of a 2026 story. And I think numbers just dropped.
NVIDIA results crossing the wire right now. Kujan, sit tight for 1 second. Revenue in the most recent quarter, the fourth quarter, $22.1 billion. The street, on average, is looking for 20.41, so a beat on the revenue side here. Gross margins in the quarter, wow. 76.7%. That was their adjusted gross margin in the fourth quarter, a beat versus what the street was looking for 75.4. Data center revenue in the quarter also beat 18.4 billion. The street was looking for 17.2 billion. Gaming revenue also a beat. Automotive revenue also a beat here as well. Here's your forecast going forward. For the first quarter, the company says revenue will come in at about $24 billion, plus or minus 2%. The street, on average, was looking for 21.9, so we'll just round that up to about $22 billion here. So it looks, Gina Martin-Adams, like at least on some of the main metrics here, they did appear to beat here, but not by a huge margin. And you're seeing that maybe reflected in the stock market reaction.
Yeah, though I'd say, down 2% looks like a light day for NVIDIA as of late. Nonetheless, it does appear that, they had great numbers across the board as far as I can tell. I'm curious what Kunjan thinks, but it looks like they had pretty great numbers. It just wasn't quite enough to sustain what had been a really high-flying stock price.
And Kunjan, maybe you can weigh in here. I know you haven't had a whole lot of time to look at this, but I think what jumps out at me is not just the revenue growth. I mean, a company that, let's face it, had about half this revenue just 3 quarters ago, but also gross margins. I mean, that's insane. 77% gross margins. I mean, where is that coming from?
Yeah, and it's really reflected in driving from the data center business. Look, NVIDIA right now is not selling chips, it's selling data center systems and is enjoying gross margins as high as a software company. So they have a lot of pricing power. Another thing is as their H200s continue to ramp and become a larger portion of their GPU penetration, that is really also helping them with their ASP. So again, everything is going their way. In fact, we expect the B100 to be announced soon, and that will again be a tailwind to gross margins for the rest of the year.
What do you think, Kunjan? What does this mean for the rest of the space? I mean, you've got Supermicro Computer now down 4% post-market after these NVIDIA results. What do you think the read-through is for the rest of the space after these results?
I think the read-through is really positive, and it should ease some of the concerns that some folks are having whether the AI rally can continue in 24. The upside, even though less than 10%, but still validates that supply is coming on better as planned, but more importantly, that the demand strength is there. And like I said, again, I would like to hear more on the demand from the enterprise side when it comes to AI spending, and because that should signal for the entire space that the AI rally is at least going to continue.
All right, Kunjan Sobhani over at Bloomberg Intelligence. Really love having him here to get that instant reaction and analysis to these numbers. I just want to walk you through those numbers one more time here. The numbers are eye-popping. $22 billion in revenue in the most recent quarter. Just to put a fine point on that, a year ago, they had $6 billion in revenue in the quarter. That's just how fast this company has grown. Now at $22 billion, the street was looking for about $20.4 billion. So you did get a beat on that top line number for the most recent quarter here. Now for the bottom line, you have adjusted gross margins coming in right around 77%. The company says that is going to hold around 77% for the full year. Its R&D expenses are up by about 26%. Its operating expenses are up by about 25%, but its operating income also up in a big way, $14.75 billion. That compares to $2.2 billion in operating income a year ago, and at 14.75, that is well above what the street was looking for. Daniel Newman joining us right now, the CEO over at the Futurum Group. And Daniel, what's your initial reaction to this report?
It's a really good print. It almost falls into this white space, though, Roman. It's so good that it beat by a substantial margin, but it's not so good that it's blowing the roof off of the market. You're seeing it's kind of sitting at a break even today. All those options are looking a little scary. Are they going to expire? Not worth anything. You know, I think now I'm looking at it, it's up about $10. Right before I came on, it was down 2.
Yeah.
But look, you know, this AI tailwind is real, and I think there's a lot of reasons for bulls to feel bullish. But I also think the clear sailing that NVIDIA's had for the last 4 quarters, this could be the end of the best period, which I think is what a lot of people are weighing right now.
Mm-hmm. Well, I mean, we should point out, they say in the press release that they feel like AI, generative AI, has reached a tipping point, and according to them, they're saying that vertical industries like automotive, financial services, healthcare, in their words, now at multi-billion-dollar levels. I think a lot of people maybe feel, Daniel, that maybe this has gone too far. Maybe we are sort of at that inflection point. But it also raises the question that even if we are, there are still going to be some kings of the hill. And is there any reason to believe that NVIDIA won't be at the top of that hill?
Yeah, it's hard to think. It took Intel multiple decades to gain 90+% of the data center CPU market. It took NVIDIA about a year of just crazy tailwinds and all the right conditions. Having said that, it also took Intel many years of falling off from its best to lose, and they still sit at 70-something% of the CPU data center market. And why do I say this? Well, the bottom line is that even if NVIDIA sees real competition, AMD is entering the space. We've heard Microsoft is going to build networking chips. They're already building AI chips. So is Meta, so is Google, so is Amazon. The bottom line is that it's going to take a long time between the software, the stickiness of all the hardware, all the cloud providers that are selling it, to see any meaningful fall off. I could see it dropping to 90% in the next year. I think they're going to have some competition, some margin compression. But as a kingmaker in the AI space, it's going to take a long time to see a meaningful change.
Daniel, I'm curious how you think about valuations in this space. Is there a multiple you can actually put on this AI group? Is there a multiple you can put on NVIDIA? I keep hearing all week, you know, yeah, NVIDIA stock has surged, but valuations are quote unquote not that expensive. How do you assess the valuation multiples of this whole space in an environment that is moving this quickly?
So you look at, I want to use the Sam Altman $5 to $7 trillion AI chips opportunity maybe as a backdrop for this particular calculation. So when you look at what Sam is suggesting, he's not just talking about the chips. He's talking about, you know, foundry, silicon design. He's also talking about data center, and then all the electricity and infrastructure that's required. Having said that, you saw a $20 billion quarter for the most important company, or $22 billion quarter for the most important company in AI chips. And you'd say there's a lot of growth ahead. So if you look at a forward multiple and you say, can NVIDIA continue this growth rate, and are all these conditions, whether Sam goes and partners with Intel or whether Microsoft builds its own accelerators, can NVIDIA keep growing this way, law of large numbers, a little bit like what we saw with AWS in the cloud, you start to say, maybe it isn't that expensive. My biggest concern, though, is the gross margin. Romain, you pointed out a few times, 76% gross margin. But AMD's not really shipping at volume a competitive product yet. Intel doesn't have a competitive product yet. Mostly what we're hearing are competitive products entering the space. And we're also hearing demand time coming down. And you're wondering, supply time is coming down. And you're wondering, is there any issue with demand? So all these things are going to impact whether NVIDIA can keep this high margin. If they can keep the margin and AI keeps growing like we forecast it will, then it may not be as expensive as some people think.
I'm glad you brought up that competitive landscape, because I too think this is a big key. This has been the 500-pound gorilla in the space for the last couple of years. It's kind of the only player. At what point do those competitors come to market with products that diminish the market share of this company?
Well, the reason I'm a little bit skeptical, and in 2020, I said NVIDIA would be the next trillion-dollar company. In 22, when it was trading at around 130, 140, I said that NVIDIA was an absolutely massive opportunity for investors. Now we sit here at the other side of this, and you start to say, well, AMD's starting to ship. Lisa Su's talked about a $4 billion forecast. Intel had Gina Raimondo Sam Altman, Satya Nadella making commitments to work side by side. And of course, all those companies are building their own chips. And then you have the question of how many companies are going to build these massive large language models that require all these GPUs. GPUs are really good for doing a lot of things, but these lower cost, lower power consuming ASICs from, there's these application specific chips that come from, companies like Microsoft that they're building. AWS has had for a number of years. Meta's built their own. Google's built their own. You got startups like Grok and Samba Nova that are building very efficient language processing chips. The margin's going to come down. I don't see any way that they're able to protect this margin when you see 2 or 3 entrants into the market, let alone 15.
All right, Dan, great stuff, and I always appreciate you jumping on here right in the thick of things for that instant analysis. Dan Newman over at the Futurum Group, a closer look at NVIDIA. The shares have been oscillating between gains and losses right now, up about 3% here in after-hours trading. And, of course, there's been so much talk here about AI and, well, whether it's, just hype or actual substance behind it. One of the interesting surprises out of NVIDIA, and quite frankly, out of the 13F filings that we get from hedge funds, was NVIDIA's 13F filing, which showed its investment strategy in this space, taking up sizable stakes in several companies using generative AI, and that includes biotech firm Recursion Pharmaceuticals. Joining us now for an exclusive conversation is the co-founder and CEO of Recursion, Chris Gibson. Chris, great to have you here on the program. And I think this is really important, too, to sort of kind of cut through some of the hype and get to sort of the nuts and bolts of what generative AI really is, and more importantly, what it could actually mean in terms of practical applications. Big Pharma kind of figured this out, or at least they tried to start figuring it out several years ago. And we've seen this application and being able to identify the shapes of proteins, being able to identify potential, the use of drugs and how they interact with each other, or molecules, I should say, interact with each other here. How far along are we in that process where regular folks on the ground are going to see the real world benefits of it?
I think we're in the very early innings. You talked about using tools like ML and AI to try and understand how proteins are folding. We've seen some incredible advances in the last couple of years there. But the process of discovering and developing a medicine is hundreds of steps. And we're really just seeing ML and AI start to play a role in the first few dozen of those steps. And as we start to put together these tools at different levels, across multiple of these steps, we're going to get compounding efficiencies. So from our perspective, it's very, very early days. And that's a company that's been working on this for a decade.
So the promise, though, is that as this technology evolves and as the application of it improves, the idea is that the amount of time it would take to get from idea to an actual drug that can be brought to market, that gets shortened. I mean, how much is that going to be shortened potentially?
Yeah, I mean, there's some pieces of that are pretty hard to shorten. The clinical trial process, you can't change the scale of biology in humans. It's going to take time. But ultimately, the most important piece of this is that 90% of drugs that go into clinical trials actually fail. And so the biggest lever to be pulled is increasing the probability of success. What we always tell the team is if 80% of our drugs that went into clinical trials failed, we would be twice as successful as the industry average. And I think that's the bigger lever that we're going to see. Time and cost will be an important one, but it's really about that probability of success. And this is not going to happen overnight. This is going to take a decade or two for us to see really meaningful movements there. But ultimately, this is a massive market, right? A multi-trillion-dollar biopharma market with 90% failure rates in the clinic. And so the upside for human health and impact, I think, is pretty extraordinary as these tools start to take hold.
Talk to us about the ultimate cost reduction here. What does this mean for the end consumer cost? Clearly there's an embedded cost that starts to go away, it's diminished materially over time. If we're looking 5-10 years from now and this is truly effective, what does it mean for the price of drugs?
I think over the next decade, we're going to start to see the price of drugs fall. Of course, part of that will be other forces in the market. The biopharma R&D engine is one component, but PBMs and other things are actually a much bigger component of the price of medicines. But ultimately, if companies can start reliably discovering and developing meaningful, impactful drugs that make a big difference for patients, and they can do it with less failure, that will drive extraordinary cost improvements. And so I think if you're looking 10 to 20 years out, I'm very, very optimistic. Next 2 or 3 years, I don't think we're going to see any real effect.
Can you talk a little bit about your use of large language models? I think you have some real life applications, and this is oftentimes a really difficult concept for investors to get their head around.
Yeah, so I think one of the things that makes us very different from many other companies in this space is that we have a massive laboratory full of robots that are generating petabytes of proprietary biological and chemical data. And there's also, hundreds of thousands of papers out in the public domain that people have published on. Bringing those two sources of data together is really, really challenging at that scale. And so we use large language models and all kinds of different ML and AI models on our own data, on public data, to look for arbitrage, to look for places where we've generated our own proprietary biological data that suggests to us we have found a relationship in biology or chemistry that the rest of the world does not know. And that's actually where we focus our time. And one of the most interesting things for us, talking about the cost differences, is 18 months ago, almost 50 people at our company were exploring the literature and using all of our other tools to start new drug programs. Today, no people for our internal pipeline are actually starting new drug programs. It's entirely automated through the use of LLMs and other tools that we've built. And people get involved, but they get involved later after we've gotten a lot of the inexpensive failure out of the system.
When we talk about, and that's a great point, Chris. So when we talk about sort of, I guess, what AI and some of these language models can do to sort of speed up this process, you alluded to this idea that there's still a lot there that we're not going to sort of solve in terms of reducing the time. There's still got to be a lot of legwork, human legwork that is, particularly on the testing side, et cetera, here. Has there been any discussion, particularly not just amongst your peers, but also with regulators, as to maybe how that side of it can be improved as well?
Yeah, actually, a lot of credit to the FDA. They put out a white paper in May, I believe, talking about their use of large language models and the future they see for AI. And I would suggest they're actually ahead of many other of the large companies in the industry in terms of thinking about how they're going to leverage these technologies. Again, it's still very early days, but for an agency whose job it is to keep patients safe and to make sure medicines are efficacious, I think there's a tremendous amount of opportunity for them to use LLMs in particular. Where I think it's going to be challenging is that clinical trials take a long time because we have to actually do the experiment in humans and see if the drug makes a difference, see if the drug is safe. And it's very hard to use any kind of technology to compress the amount of time that it takes to see biology express itself. So I don't think we're going to see clinical trials shrink, other than the use of precision medicine and all of the data sets that healthcare systems have now, that they're making more and more accessible. We'll be able to find the right patient much more quickly and enroll trials much more quickly, but we're still going to have to let the biology play out on whatever time scale it takes. So maybe a 2-year trial comes into 12 or 14 months, but you're not going to compress a 2-year trial into 2 months.
All right, Chris, this was a great discussion. Obviously, you're very passionate about this, and we'll catch up with you again soon, I'm sure. Chris Gibson, the co-founder and CEO of Recursion Pharma. Those shares up about 5% here in after-hours trading. Remember, we learned last week that NVIDIA had about a $76 million stake in the company. Of course, NVIDIA earnings are out, and those shares are higher right now as well, up about 6% here in after-hours trading. We're going to continue our discussion about NVIDIA, but we do want to check in on a number of other companies that are reporting earnings here after the bell, and that includes Marathon Oil. Abigail Doolittle standing by with a closer look at what we learned. Abigail.
And those shares are higher right now, Romaine. They are up about 2.89% in the post-market. They traded well into the quarter. They beat adjusted earnings, putting up 69 cents versus the estimate of 65 cents. Now, it's interesting because, of course, the CapEx budget is pretty important. So they're talking about $1.9 billion to $2.1 billion, and that on this, they expect to generate, I believe it was, I saw 190,000 net barrels of oil per day. Wow. They are, so that's a positive for certain, and it's being received that way by investors. They're also looking to deliver approximately $1.9 billion of cash flow. That assumes $75 per barrel oil price and a $2.50 gas price.
And then we move to the poor electric vehicle production folks, such as Rivian. Not quite as good a news out of EVs. Rivian ceased production at 57,000 after an estimate of 80,000, so quite a big miss there. They also announced 10% cuts to salaried jobs. Their cash position, not as good as anyone was hoping, or at least as good as the street was hoping. And the bright spot is at least revenue was a little bit better than expected, but certainly the sustainability of that revenue growth is really under question in the analyst community, and the stock is reflecting that. I mean, generally EV has had a tough go. We saw other EV producers as well coming out with results that maybe weren't as good as many had hoped, and it's been a tough environment for this space.
It certainly has, and the stock is reflecting it, as you mentioned, down 17.2%. It's hard to know whether it's the headline of the production cut to 57,000 versus that 80,000 expectation, cutting the 10% of the salaried staff, which we have seen so much of from so many different companies across the board, and also their cash position. I mean, it's worrisome for a company like this that is in the, let's call it startup phase, $7.86 billion, which sounds like a ton of money, but the estimate was for $8.74 billion. So yeah, this stock is very much under pressure. Yeah, to say the least here. Those shares now moving lower here in after hours trading by about 15-16%. Lucid, which also reported down about 6% here on the day. We should point out Etsy, which also reported results down about 3% here. Nvidia still holding on to its gains. Our thanks to Abigail Doolittle. Stick with us though, because we are going to have a fuller breakdown here of what's everything that's going on with Nvidia. This was a very consequential day coming into the markets as everybody looked at what had been the main driver of the rally over the past few months. That was Nvidia, and the pullback that you saw in the market today, well, it wasn't as bad, well, as it could have been. The S&P 500 closed higher by about 0.1% on the day, despite being in the red for a good portion of the day. The Nasdaq did finish lower by 0.3%, and the Russell by about 0.5%. Modest uptick in yields across the board, and a lot of activity today in the energy space. Stick with us. More coverage coming up after the break. This is Bloomberg. A focus here in the after-hours session on Nvidia, those results just crossing the wire. Relatively decent beats, both in terms of the most recent quarter as well as their guidance going forward. Those shares moving higher by about 6%. But there's a lot of focus right now, not on Nvidia, but, well, where Nvidia sees opportunities. That 13F filing we got out of the company last week showed stakes in several AI companies. That included a $3.7 million stake in SoundHound AI. It's an audio recognition firm, and it works with brands like White Castle and Jersey Mike's to make the customer experience more convenient at the drive-thru. SoundHound's technology can also be found in cars, smart devices, and in call centers. Pleased to say, joining us in studio right now is the CEO of SoundHound AI, Keyvan Mohajer, joining us right now. Keyvan, thanks for being here. You must be the man of the moment as of late. I think everybody is looking at NVIDIA, but anything that NVIDIA and Jensen Huang touches, of course, everybody wants to be a part of here. What exactly is it that Jensen Huang and his team saw in SoundHound?
Well, thank you for having me. So SoundHound, we specialize in voice and conversational AI. We think speaking to devices and services is the most natural way to interact with devices and services. And we are very happy to have NVIDIA as an investor. We've known them for years. And so NVIDIA creates the infrastructure for AI, and SoundHound utilizes that infrastructure and puts them into good use. And we've been very successful at attracting strategic investors. We have companies like Samsung, Hyundai, Vizio, and Oracle have invested in us. And that creates both validation and alliance. So validation because they have their own people looking at our stuff and making sure that this is really good, the vision is good, the technology is good. But also alliance because we get close to these companies, and some of them, like Hyundai, has become one of our biggest customers.
Talk to me about what has changed with the technology, because this overall isn't new, the baseline of it. I mean, I go back 20-something, 30 years ago, I remember you had companies, whether it was the voice recognition companies or some of the other ones trying to do more sort of automated audio, if you will, whether it's at the drive-thru, on customer service call centers. Why is the technology and the generative AI and language models that we're using today, why does that make it better than maybe what we had in the past?
So generative AI was the big step change that we needed. So, for example, when Apple came up with their multi-touch touchscreen, it was so much better than the previous one. It wasn't the first, but it made it so good that before smart devices, smartphones were like a minority, but now everybody had it, right? So with generative AI, they are making voice assistants and voice AI customer service generally available to everyone, and that has just happened in the last 12 to 18 months. Now, generative AI by itself is not enough. It's a means to an end. Some people think you can just plug it in and it works. But we had to do a ton of software engineering around it to make it work and actually be able to go live in production.
Can you talk to us a little bit about the real live customer experience and how that's going to change over the next 2 or 3 years? I mean, you work with some pretty big brands that most of us touch and feel, Jersey Mike's, White Castle. What is that customer experience going to look like in 2 or 3 years' time? What are you working on now that we can look forward to?
So at SoundHound, we made 2 predictions, and we focus on those 2 predictions. The first one is that AI customer service will be as necessary for every business like Wi-Fi and electricity, right? So you create your business, and you sign up for Wi-Fi, you sign up for electricity, you sign up for AI. And we specialize in that. The second thing is voice will be the preferred way to interact with devices, right? So 75 billion IoT devices, from cars to TVs to other smart devices. My 3-year-old daughter knows how to speak, but I still have to teach her how to use a keyboard and a mouse and a touch screen. But she's going around the house and talking to everything, right? So speaking is going to be what people prefer to interact with these devices. Unfortunately, for the device makers, they could afford to add a very small, inexpensive microphone, and that's all it takes to add voice AI to products.
And for that end customer, what does their ultimate cost savings look like? How much cost are you taking out of the system in addition to providing the great experience?
Well, it's both cost saving and revenue. For example, with White Castle, they're using our AI to automate their drive-thrus. Now, we can take orders in less than 60 seconds, which is faster than human order takers. The quality also is more accurate than the human order takers. But we are not replacing those humans. We are freeing them up to prepare the food and help with labor shortage, right? So faster order taking is more revenue, and then saving cost. The other example is Jersey Mike's is using our AI to automate their phones. So when you call a restaurant, usually they don't pick up the phone.
Right.
Or when they do, they're in a noisy environment, they're distracted, they're multitasking, you don't get a good experience. But with our AI, no call goes unanswered. Right. And if callers are asking a question, we answer it. If they want to place an order, we take the order.
What's the quality of that call, though? I mean, there's been so much anecdotal stories about people calling customer service lines and basically getting responses that really weren't addressing their question, if you will. So it's one thing to have the technology, but if I ask it something specific, is it going to give me an answer that would be satisfactory, or at least would be commensurate with what I would get from a human who can understand my nuances and everything else?
So that's the big transformation that generative AI enabled us. So the experience that we remember from years ago was those old-style IVR systems. Yeah. So those have been completely disrupted. Okay. Generative AI allows you to ask any question that they can actually be better than humans. And let's talk about IoT devices like cars. We used to use our cars to just dial digits or maybe barely do navigation. But we integrated generative AI with our platform. We power more than 20 car brands, and we ran pilots with a bunch of them. And the result of that pilot was so amazing. Like the usage went up multiple folds, the user experience went up through the roof, that they announced, like our partner Stellantis announced, we actually had a press release today that we are the first voice AI provider with generative AI to go live in production in 18 countries.
What's the growth story here for SoundHound going forward here? I mean, you're relatively new to the public markets. I mean, I know it's been, what, 3 or 4 years, but you're still relatively new. There's been a lot of discussion as to how you generate a more longer-term revenue story. Where does that come from?
So what we are really excited about is bringing our two businesses together. So we power services, we power devices, and we're going to bring those services into the devices that we power. So imagine you're driving a car. You already use your voice to interact with the car, control the air conditioning and the radio and navigation. Imagine you can also order food. So you don't actually have to get to the drive-thru. You can order in advance by talking to your car, right? And that's not enough. That's not the only thing. You can make reservations. You can book appointments. You can do voice commerce. That is the future of voice commerce.
Can I tell my son to do his homework before I get home?
Absolutely.
That would be helpful.
Just leave memos at home.
So we are in the 10,000 locations already with our customer service. We are in millions of devices. The scale is already there. We bought our biggest competitor. And it's a matter of integration and adoption by the end users. And this monetization ecosystem creates value for everyone involved. The merchants create new leads. They pay us for those leads. We share that revenue with the car maker and the TV makers and appliance makers. And so everyone gets benefit, but the most important audience is the end user. They get the benefit of the convenience of using their voice to get things done.
Do you plan on staying a standalone company? Has there been any discussions about maybe being acquired?
So we have very strategic technology and footprint of customer base. So we are strategic. We get approached from time to time, but our focus is building long-term value creation.
Has NVIDIA actually made any offer to you?
I can't comment on that.
All right, Kayvon, appreciate you taking time to be with us. Kayvon Mosier, he's the co-founder and CEO of SoundHound AI. All right, stick with us. A lot more coming up here on the show. Going to set you up for some of the big market-moving events over the next 24 hours. This is Bloomberg. All right, with NVIDIA earnings out the way, let's push ahead to some other earnings here. A much smaller player, but one that could be also important for the market, and that is Carvana, set to report tomorrow. Bloomberg auto reporter Keith Naughton joining us right now for a little bit more of a discussion about that. Keith, I don't even know where to start with this company. It seemed like it really rode the wave of meme stocks, of used car prices. Is that all over? What's the story here?
You know, the stock is still a juggernaut when you look at it. It was $5 a share in January of 2023, and now it's around 50. So it's just been on a tear. It's still a company, you know, really working through a lot of issues. But last year it was able to restructure its debt and really focus on profitability per unit sold, and that has really got investors excited again.
It doesn't seem the analyst community is particularly excited, though. So even though investors are excited, the analysts seem to be a bit skeptical that even recent retail sales gains that they've experienced can sustain going forward. What's behind that analyst skepticism?
Yeah, it's interesting because the analysts keep raising their price targets. They have to, right? Because the stock keeps going up, but they're not raising their ratings, and in some cases, they're cutting them. You know, the issue is that Carvana is no longer, or for the moment at least, not a growth story. The revenues have been down, the unit sales have been down, but that's because Ernie Garcia, the CEO, has been focused on cost cutting and focused on restructuring the company so that he takes fewer sales to get more profit out of each car sold. That's a very prudent approach to making sure this company survives, but it's not satisfying the analysts.
All right, Keith Naughton covers this for us at Bloomberg. Carvana earnings tomorrow. A lot of other events, too, that could potentially move the market. That includes a rate decision over in Turkey. But let's come back here to the U.S., Gina, because we get a slew of economic data here as well.
Yeah, with manufacturing PMI, jobless claims, existing home sales, a lot of these are pretty good leading indicators of activity to come. So I think we should be paying attention to that, in addition to all of these earnings reports that we still have to go through in the consumer space.
Absolutely. And before we get there, we're going to get a lot of Fed speak, too, that will maybe parse out some of the economic data, including from Michelle Bowman, Lisa Cook, Neil Kashkari, as well as Chris Waller. And then those earnings that you were talking about, quite a few others, not just Carvana tomorrow.
Right. I think we've got a couple of consumer companies really to look forward to. And that certainly has caught our eye, as the consumer does appear to be the space where people are most skeptical about.
Yeah, Dominion Energy, Moderna, Wayfair are going to be big as well, Intuit and Block. So a lot to cover tomorrow. So please tune in. We'll have full coverage of all of those earnings reports, the best analysis and the first analysis that you're going to get like no one else. Stick around, though. Today, Balance of Power. It's coming up next after the break. This is Bloomberg.